Hi. So, topic that I'm going to talk to you about today is fairly narrow. So, a lot of digital agencies wouldn't have this issue. So, I'll tell you right up front, you'll only have this issue as a digital agency if you actually sell to foreign customers. So, if you've got foreign customers that you provide services for, or that you sell digital products to, then you may have the opportunity. If you happen to be structured as a C corporation, that's the other if, so two ifs here. You actually have foreign customers and your business is structured as a C corporation. If those two things are true, then stay with me here, because the opportunity I'm talking about in this video is called the Foreign-Derived Intangible Income Deduction. Now, the concept with the Foreign-Derived Intangible Income Deduction is that if, whatever business you have, you should make a 10% return on your fixed assets. Now, when I make that statement, this is just an arbitrary statement that was decided on in the tax law changes that brought in this deduction that we call FDII, Foreign-Derived Intangible Income. It's this arbitrary metric that says, well, you should be able to make a 10% return on your fixed assets, and that's not related to intangible value. But any income beyond that 10% return on tangible depreciable property, any income beyond that would represent income that is intangible income, what the government's referring to as intangible income. Now, that statement of calling that kind of income intangible income is not something I would have thought of on my own previously. It's not. I don't think it's a common definition of the term intangible or intangible income. So keep in mind, this is a very specific way of defining intangible and intangible income, but it's how the government has chose to define it in this context. In dealing with international related transactions from a U.S. tax standpoint, they've decided that intangible income is income that exceeds 10% return on essentially fixed assets. So if you have this intangible income, and probably, and in your digital agency, that's probably true. You probably don't have a lot of fixed assets, so a lot of your income would be considered this intangible income under the standard. So the next question is, well, is any of that intangible income actually foreign-derived intangible income? Foreign-derived intangible income would be the income earned from selling to people located in foreign jurisdictions or services related to assets located in foreign jurisdictions. That's the way that you potentially, a digital agency providing services to foreign folks or to foreign companies, to places that are located outside the U.S., is the way a digital agency that's a C corporation might take advantage of this FDII deduction. If you have that kind of foreign-derived intangible income, if that's something that you think you might have, well, then you're going to get a deduction against that income. The deduction is 36.5% of the foreign-derived intangible income, the FDII, and when you take that deduction, it essentially takes the 21% regular C corporation federal income tax rate and drops it down to 13.125% on that foreign-derived intangible income. So there are a lot of detailed mechanics to the calculation of the foreign-derived intangible income deduction, and I'm not going to go into all of the intrinsic all the complicated details here of the mechanics behind it. The main point I wanted for this video was just that you are aware that it existed, that if you are a digital agency that serves foreign customers, either foreign companies or foreign individuals, then you may have foreign-derived income. You probably in fact have foreign-derived intangible income, and if your business is structured as a C corporation, there may be a deduction there that for you to think about if you haven't thought about something to get into. Okay, well, that's it for now. I'll see you in my next video. Take care.